corporate finance practice problem using Excel. Stock split, 3-for-1 and 2-for-1 comparison. Get ready, it's time to take our chance with corporate finance. Here we are in Excel. If you have access to our Excel worksheet and want to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We have the information on the left-hand side. Going to populate that into the blue area on the right-hand side, looking at a comparison between the stock split on a 2-for-1 and 3-for-1. So we have the market price up top at the $110. We have our statement of stockholders' equity, in essence, the equity section of the balance sheet before the stock splits taking place. And we want to think about what the impact on the equity section will be. Remember, when you're thinking about these types of problems, you can kind of think of the balance sheet, assets, liabilities, and equity. And we want to think of an adjustment that's really only going to have an impact on the equity section, meaning no impact or change on assets and liabilities, the balance sheet still remaining in balance. Therefore, we would expect then that the total equity would be the same after our splits have taken place, and there's going to have to be some adjustment within the equity section. Also note that when you think about the equity section, it represents basically the owner's claim to the assets as opposed to debtor's claims to the assets, and you can think about that as an aggregate in total equity, assets minus liabilities, book value of the company. Or you can break it out by owner, which is what really is different between the types of entities. If it were a partnership, we would have to break it out by individual partners. But due to the fact that it is a corporation, we can break it out by basically the units kind of activity that will be there, or at least be able to break it down by unit. So in other words, what do we have in the equity section? We've got the shares that have been issued. The 2,000 shares are going to be issued in our problem here. That means that they have gone out to actual stockholders from the corporation. We have then received money for that. That is similar to, say, a sole proprietorship or partnership initially putting money into the business in order for the business to later be able to generate revenue on it. It's the initial kind of investment. So that would be the corporation issuing the stock, getting money for it. Now, oftentimes the stock will have a par value, which is an arbitrary number, has nothing to do with the market price, has nothing to do with the money that we actually got when issuing the stock, because we're going to issue the stock, for whatever we can issue it for to get as much money as we can when we issue the stock. And therefore, the par value is simply to have this nice even common stock number, making it easy for us to figure out how many shares are outstanding with that common stock number. Now, of course, we're going to issue the common stock for something greater than that. And therefore, if we have a par value, we're going to have then a paid in capital in excess of par, representing the money that we got for issuing the stock over the par value. These two amounts then represent, in essence, the owner's investment in the company through the initial issuing or the issuance of the stock from the company. Then we have the earnings that have been retained. That means that earnings that have generated over time through the operations of the company, which have not yet been distributed out in the form of dividends going to the owners, those being the stockholders. So when we issue the dividends, then this value here, it should come out of this value and not out of the initial payment. Otherwise, you could have differences in the tax impact and whatnot. And that then gives us the whole total equity amount. So once again, total equity is not going to change, but we're going to have changes to the components of the equity section here. So let's pull over our statement of equity again on the right-hand side, and let's add what we have thus far. So I'm going to be pulling this over. Let's actually bring this up. I'm going to pull this whole thing up a bit. It should already be there for you, but I'm going to pull it up like this, and so it's kind of even there. I'm going to pull this one up as well. Let's pull that up there. Okay. So now we got a nice even thing here. Let's go. This is going to be equal to the common stock. I'm just going to pull over the same numbers, and I'm going to practice putting in my totals so that when we make the adjustment, we can then adjust it in the blue area here. So I'm going to go ahead and use the autofill, copying this down, putting my cursor on the fill handle, dragging it down. I'm going to do some indentation so it looks the same, grabbing these three, going to the alignment, indenting it, and then I'm going to go to the common stock, indent it again. And so there we have it. Let's pull over the numbers now. We're going to say this is going to be equal to the 2,000. I'm not going to drag it all the way down because I want to put my subtotal calculations, the sum calculations in place. So I'm going to pick up the 10, underline that by going to the font group and underline. Then we'll go ahead and multiply this out. So we got the shares, 2,000, par value of 10. That gives us the 20,000 additional paid in capital at the 14,000, the retained earnings at the 43,000. These three numbers, the 20, the 14, the 43, is going to give us the total equity calculated as the sum equals the SUM of the 20, the 14, and the 43. That's going to give us then the 77,000. Let's go to the font group and underline that. So I'm going to go, after we do the calculations, going to come back in here and change these numbers in our blue equity section. Let's think about what the shares will be after the split if we have a 2-for-1 stock split. So we got the beginning shares. So say the beginning shares, which is going to be equal to the starting point of the 2,000. We want to pull the 2,000 from this section, not over here if you're using a formula, because we're going to change these items here. And then we're going to say there was a 2-for-1 stock split. So we're just going to double those. Let's just say 2, multiplying it times 2. Font group and underline, that's going to give us our ending shares. Ending shares then being the 2,000 times 2, 4,000. 4,000 shares. That makes perfect sense. That means this number is going to change to 4,000. Let's not do it yet. We'll do it soon. Then we're going to have an adjustment to the par value because this is a split scenario as opposed to a stock dividend. So the beginning value for the par value is equal to the $10 over here. And we're going to take that and divide it by 2, underlining that by going to the font group and underline. And that's going to give us, of course, 5. 10 divided by 2, 5 for the par value. Par value then at the 5. So if we then change these two numbers, of course, all that changes, the ending number is going to remain the same. We're going to say that we now have the 4,000 shares and they have a par value of 5. 4,000 shares, par value of 5. These are the two items that have changed. Note that the bottom line number remains the same at the 77,000. Okay, now let's do it down here and say, well, what if we had like a 3-for-1 stock split? Then what would happen? All right, similar kind of process. Let's do the same thing. I'm going to pull over our equity section again in a similar fashion. And we're going to copy that down. I'm going to autofill this down. Let's do our indentations just so we get a feel for what the equity section looks like. Selecting these cells, alignment, indent, common stock, and then indent that again. Pulling over the numbers, this is going to equal the 2,000. This is going to equal the $10. Let's underline that, font group and underline. We're then going to multiply the 2,000 times 10. That gives us the par value at the 20,000. This equals the 14,000 paid in capital in excess of par and the retained earnings at the 43,000. Summing up equals the SUM of the 20, the 14, the 43. That gives us, of course, the 77,000. That's our starting point. Let's go to the font group underline. We're going to then change, you would think, once again, these items. Let's go ahead and yellowify that. Do a quick calculation on the right to see what that change will be. We're going to say that the starting point, we're starting from the beginning point again, not after the split, but we're starting from our original numbers. Beginning shares were at 2,000, and now we tripled them. Tripled the shares instead of doubling them. Font group, underline, so that gives us the ending shares after being tripled at the 2,000 times 3 or the 6,000, which of course is going to be then this number here. What's going to happen to the par value, because it's still kind of a split type of situation instead of a stock dividend. So we're going to adjust the par value. So that of course will be the begin. I don't know why that word always causes me a problem. That word is a trouble word for me. I can't spell it. And I'm just going to say that's the 10 divided by 3. We're going to underline it, font group and underline. And that's going to give us our ending par value, which is going to be the 10 divided by the 3. Adding some decimals, that's not an even number. That's not even. Number group, couple decimals. There we have it, 3.33. So if we change that here, and note there is rounding that's being involved here, I'm going to actually use this number over here because it's really 3.333 on forever. We would have to kind of cut it off at some point, but I'm going to use that number, which is not rounded. So we're going to take the 6,000 shares, and then we're going to pick up the 3.33. We, of course, now have 6,000 as opposed to the 2,000. The par value, let's add some decimals, number decimalizing it, has then adjusted. Common stock remaining the same. We have the bottom line number also the same down here. So now let's say, okay, well, what then would be the impact? Because now we've got more shares that are out there. Let's think about the earnings per share calculation. What if we think about that on like a per share basis? What happened then? Well, if we think about our earnings, this is on the income statement number. We said that the earnings were at the earnings at the 18,000 was our starting point of the earnings. And on a per share basis, then that's like our net income number. We'd say, well, before we had shares of the 2,000 shares. So if we say, what if we started at the 2,000, what would be the earnings per share? Underlining that, font group and underline, that's going to give us our earnings per share, which is going to be equal to the 18,000 divided by the 2,000, adding a couple decimals, number group decimalized. $9, it's even. Didn't have to decimalize it, but that's okay. And then, then of course, this is going to change if we have twice as many shares and the earnings hasn't changed. So the earnings then remaining the same now, same number on the earnings, still at the 18,000. I'll just pick it up from up above this time. That'll be easier. But now the number of shares we're going to say is doubled. 4,000 shares out there. 4,000 now shares out there. Let's go to the font group, underline that, and say now our earnings per share after the stock split is at the 18,000 divided by 4,000 shares out there. We're going to go to the number group, add a couple decimals. We're at the 4.5. And of course, that's going to be substantially lower, like it's halved. But if you owned one share before, now you have two shares. So it shouldn't really have, if you're an owner of the shares and your stocks got doubled, you would then say, okay, I got twice as many shares, but from an earnings per share standpoint, I get half as much in terms of the earnings on a per share basis, which would make sense. What happens if we do the 3-for-1? The 3-for-1, let's say the earnings is the same. Earnings is the same then. But now we got more shares again. Shares have now increased by not up to 4,000, but now the shares are at, what are the shares at? 6,000. 6,000 on the shares. Let's go ahead and underline that font group, put in a line underneath, which we call the underline, because the line is under the text or the number. So that's going to be the 6,000 divided by the 18,000 divided by the 6,000, adding a couple decimals. So once again, the earnings have not changed. The number of shares have changed. Earnings applied out to the larger number of shares goes down. However, if we were a shareholder before and we got two more shares, we now have 3 shares instead of, and so the 3 shares, if I add them together, adds up to the original 9 here once again, as would make sense. Now let's think about what would happen to the stock price. So if we're saying that the original stock price, as we said over here, was the 110 per share, we would expect, and remember, this is something that would happen on the market, so it would be determined by the market, but the market should reflect what we would do, and we have doubled a number of shares if we did a 2-for-1, triple the number of shares if a 3-for-1, without changing the underlying conditions, no change to assets or liabilities of the company. So you would expect then the market for a 2-for-1 split to take that 110 price and divide it by 2. So now if you had 1 share of stock before at the 110, you'd have 2 shares, which you would expect the market to reflect at the $55 given the change that took place. And if it was a 3-for-1, we would take the 110 divided by the 3, and we would expect the market to reflect, let's add a couple pennies here. Number group, add some decimals. We would expect the market to reflect 36.67 about for a 3-for-1 stock split. Same scenario, same rationale. We have now 3-for-1. We have more stocks that are going to be out there, no change to the underlying conditions. Therefore, the market, because it will react to what we do, should make the adjustment, and that's what you would expect it to be.